everyone, I'm Soni from the Derivatives desk, and in this series of Decoding Derivatives, let us understand how neutral strategies work best for a very sideways market. Well, whilst there are multiple strategies, the best strategy to work for is called Iron Condor. Now, what is Iron Condor and how do we go about it? Iron Condor is a strategy where you need to sell two options. It could be at the money options. It comprises of call and put option. And to hedge this position, you also have to buy a deep out of the money call and put option. Let us take a real example of how the strategy works. Whilst we'll be telling you about the example using real market prices, however, please, it is important to remember that this is just a hypothetical understanding and it's a purely educational series. Let us consider the 26th September of expiry for Nifty, which is a monthly expiry. Now let us say if we are considering that the entire range for Nifty can remain somewhere, let's say between 24,800 to 25,400, 25,500 for the September series. Now for this kind of a sideways market, what is the best strategy that can be applied? When it comes to Iron Condor, we can do a 25,000 call option selling and we can also do a 25,000 put option sell. So it becomes an at the money call and put option sell. Now, if you look at the prices for 26 September, 25,000 call option is quoting around 400, 420 and 25,000 put option is quoting around 260, 280. Now, let us consider that the call and put sold both the premium gives you a combined premium of approx 700 rupees. To hedge these positions, we have to buy a deep out of the money put option and a deep out of the money call option. So in this case, we can buy a 24,500 put option of the same expiry, which is 26 September. And the current price that we can see is somewhere around 130 odd rupees. On the call side, to hedge, we can do a 25,500 call option, which is somewhere quoting around 160, 170. Now, if we combine the buying options premium, it gives you a total combined premium of approx 300 rupees. So my 700 rupees is the total premium inflow. My 300 rupees is the premium outflow. This combination of all four leg strategies becomes an Iron Condor strategy. We have sold two at the money call and put options. To hedge, we have bought one out of the money put option and out of the money call option. Now my 700 rupees, which is a premium inflow, minus these 300 rupees, which is my premium outflow. The total premium that I'll be left with is 300 rupees. 700 minus 400 becomes 300 rupees. So from here we can see that the trading range for the entire strategy can be somewhere between 24,600, 650 to 25,400, 450 odd levels. Now we can always take a 50 points of leverage. That's the reason why I've said that the range can be from 24,600, 650 to 25,400, 450. This is my profitable range. If the expiry happens below the lower end of the range or the above the higher end of the range, the strategy can give you slight loss. In that case, the hedging works. However, the profitable range will only remain between this particular range. Now, this 400 points is your overall profit that you can gain, and your maximum loss will increase only if the range is broken or breached. Now, this is how Iron Condors work. It works well if you can say a very sideways market, a neutral strategy, and you can also apply it to different indices, to different stocks where you do not have a very volatile or a one-sided directional move for the index or for the stock. Now let us understand if we want to broaden the horizon or broaden the range of the strategy, because maybe our view is not entirely dependent on the at the money options. In this case, can we do a tweaking of the strategy? The answer is yes. Now how to tweak the strategy? Instead of selling at the money call and put option, you can go a slightly lower and a higher strike, which could be a slightly out of the money. Same example, same strategy, let us tweak it. Instead of selling 25,000 call and put options, now we'll sell 24,800 put option of the same expiry, that is 26 expiry. Premium is quoting somewhere around 200, 220, and we can sell 25,200 call option somewhere around 300 odd rupees. Now here my total premium inflow becomes 515. Earlier, the previous example, my total premium inflow was 700 because we were doing at the money. But now we are doing in the money, so my premium inflow drops down to 515 odd rupees. Now to hedge the strategy, we have to go a bit further than what we had chosen in the previous example. Here we'll buy a 24,200 put option, somewhere quoting around 90 odd rupees. And on the call side, we'll buy a 25,800 call option, which is quoting roughly about 85 odd rupees. Now here my premium outflow is 170 to 175 rupees. So now my total combined premium, that is my premium inflow minus my premium outflow, comes about to 340 odd rupees or 340 odd points. Here my strategy is tweaked, so you can see that the range is also broadened. It has a different level right now. Earlier, where my break even or my profitable range were 24,600 to 25,400, now my profitable range is broadened. It is roughly somewhere between 24,450, 460 odd points to 25,540 or 25,550. So that level, that range of 100-150 points extension you can see. Now, what does exactly it mean? So why should we go for this strategy or maybe the previous strategy? The previous strategy where we were selling at the money, it is very important to understand that we were doing it only when we understand that the market may not move much from the from the at the money options that we have sold. Whereas if we feel that because the entire expiry is left, there could be some movement and we wish to just extend our range and extend a profitability point, even though my total premium inflow may reduce, which is fine with me, but I just want to be a bit safer, understanding that I can extend my range. So in that case, we do out of the money options. So you see how the option is tweaked. In the first and the second option strategy, you have a difference of approx about 130-150 points of a range. Sometimes it can help. Now you can further tweak it according, and you can go even deeper out of the money call and put option sell, and even way deeper of a buying of the call and put options to hedge a strategy. You can tweak it in multiple ways depending on how your view holds for the entire series. You can do it even for weekly options, you can do it for monthly expiry. Well, of course, if you're doing it for monthly expiry, it would be quite advisable that you have a very broad range and do not play with such a small range. As the range, if the levels get expanded or the level gets breached or broken, then of course there could be a rise in risk as well. So this is how you can tweak it in multiple ways. You can have multiple strategies, but overall, remember that Iron Condor is all about two legs of selling a call and put option, and to hedge the strategy, you have to go with the buying of a call and put option, which has to be a strike higher or a deeper out of the money than the call and the put options that you've sold. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.